Greetings to all stock explorers joining us today. We're taking a comprehensive look, really a deep dive into Chegg Inc.
Right, a significant player in educational technology.
Definitely. And they're navigating some major shifts right now. You've probably seen the recent news about losses, layoffs.
Yes, it's certainly caught the attention of investors, which is why we're digging in.
Exactly. So in this analysis, we really want to address some key questions for you, the potential investor.
Like, what is Chegg's core business, fundamentally?
Right. And what are the big obstacles impacting their profitability right now? Because there clearly are some.
And then, crucially, what's the plan? What are the potential paths back to making money?
We'll weigh the pros and cons, the things you should consider, and maybe most importantly, what milestones to actually watch for going forward.
We've looked at quite a bit of information to bring this perspective together.
Okay, let's get started then.
Let's do it. So to understand where Chegg is now, you really have to grasp their, let's say, traditional business.
Their foundation.
Yeah. It's always been this direct-to-student subscription model. Think digital homework help.
Like tutoring, but online subscriptions.
Pretty much. Homework help across subjects, writing assistance, math support, that kind of academic help.
And that subscription model was their bread and butter for a long time.
Absolutely. It was the cornerstone.
So how's that core business holding up lately? Let's look at Q1 2025. The numbers are, well, they're a bit mixed, aren't they?
They are. Revenue came in at $121.4 million.
Which sounds okay, but it's down 30% compared to last year. That's substantial.
It is. But interestingly, it actually beat analyst estimates.
Okay. And subscription services revenue specifically.
Also down 30% year over year to $107.6 million.
So the core is shrinking, maybe retaining more committed users, or perhaps price hikes push some out.
Could be a mix of those. But then you look at the bottom line, a GAAP net loss of $17.5 million.
Which is much worse than the $1.4 million loss in Q1 last year.
Right. And it's important, to look at both GAAP and non-GAAP. Non-GAAP, which strips out some items, showed a loss of $6.7 million.
So even beating revenue expectations, the path to profit seems tougher. The market reacted positively, though.
It did, to the revenue beat. Maybe a sign of relief it wasn't worse. Or perhaps seeing potential in new areas.
Okay, so revenue beat, but losses widened. What actually drove that revenue surprise then, if not the core subs?
It really came down to their diversification efforts starting to show, maybe a little earlier than expected.
Like what?
Well, a big one is content licensing. They signed deals with two major tech companies.
Licensing their Q&A content.
Exactly. That brought in $4 million in Q1, and they expect another $7 million in Q2.
Interesting. How much of their content does that use?
Get this, less than 5%. And the deals are non-exclusive.
Wow. So there's potentially a lot more room there.
Huge potential. But, there's a bit of irony, or maybe risk, licensing content to the very AI companies that are disrupting their main business.
Yeah. That's a delicate balance, isn't it? Selling shovels during a gold rush, but maybe to the claim jumpers.
Something like that. It's definitely something for investors to watch closely.
Okay, what else helped the revenue beat?
We also saw progress in their business-to-institution efforts, B2I they call it.
Selling directly to universities and colleges.
Right. They ramped up pilot programs from 5 to 15 just in the last quarter. The goal is 40 by year end.
A shift in strategy there. Anything else?
And Busuu, their language learning platform, showed some positive signs. Revenue up 7% year over year in Q1.
Driven by B2B.
Yeah, strong B2B growth there, up 29%. So these newer initiatives are definitely pulling some weight.
Got it. So the revenue beat wasn't the core business improving, but these other areas kicking in. Still, that big JAP loss needs explaining. What caused the $17.5 million loss?
The main driver was a big one-time charge. $16.2 million for accelerated depreciation.
Depreciation on what?
It relates to their decision to streamline products, discontinue some assets like content and internal software, basically cleaning house.
A strategic write-down then?
Essentially. It hit the gross margin hard in the quarter, knocked off about 13 percentage points.
So it hurt short-term numbers, but it signals they're trying to adapt, shed things that don't fit the future, maybe post-AI.
That seems to be the thinking. It was the main reason their earnings per share missed forecasts, too.
Right. That makes sense. So a tough environment, strategic pivots with immediate costs, hoping for long-term gain. Now, management sounded pretty cautious looking ahead.
They did. They basically said, look, trends might worsen before they get better.
Why so cautious? What's driving that?
Two big things, mainly. First, Google's AI overviews.
The answer's showing up directly in search results.
Exactly. It keeps users on Google, less traffic clicking through to sites like Chegg. That hurts acquisition.
Okay, and the second thing?
Just the increasing availability of really good AI, often for free or free premium tiers for students. Think OpenAI and Anthropic.
So direct competition for student attention and wallets.
Absolutely. It puts huge pressure on their subscription model. Shows how fast things can change.
No kidding. Given those headwinds, what's the actual strategy? How do they plan to get back to profitability? Sounds like it has a few parts.
It does. It's sort of a three-pronged approach, as they lay it out.
Okay, prong one.
Aggressive cost restructuring. They're cutting deep.
We saw the layoff news.
Right. The Q1 restructuring aims to save $45 to $55 million this year, and then $100 to $110 million annually from 2026.
And that's on top of previous cuts.
Yeah, there were savings already planned from 2024 restructuring, another $120 million expected this year. So potentially $165 to $165 million in non-GAAP savings in 2025.
Wow, that's significant cost cutting. So for investors, seeing if those savings materialize is key.
Definitely a major lever they're pulling.
What's the second prong?
Revenue diversification. Reducing that reliance on the direct-to-student subs.
Which means scaling up things like
Scaling up content licensing, expanding those B2I contracts, and driving growth in Busuu and Chegg Skills.
Okay, now the third part.
Making sure those growth segments actually become profitable. They've set targets.
Why for Busuu?
Yeah, Busuu aiming for positive adjusted EBITDA by Q1 2026. Chegg Skills targeting profitability and positive revenue growth in 2026.
So the whole plan hinges on scaling these new things fast enough to offset the decline in the core Chegg study business.
That's a challenge. It's a big lift.
It really is. Let's talk about gross margin for a second.
Yeah.
You mentioned it took a hit in Q1.
Right, 56% GAAP, 57% non-GAAP. But again, heavily skewed by that one-time charge.
So without that charge, what would it have looked like?
Probably closer to 69%.
And how does that underlying 69% compare historically and to competitors?
Historically, Chegg's margins have been pretty healthy, often in the low 70s non-GAAP, so 69% is still decent, competitive with peers like Coursera or Instructure. Duolingo's higher, though.
And what are they guiding for Q2 margins?
They expect it to bounce back somewhat, guiding 64% to 65%. Suggests that Q1 hit was temporary.
Okay. Let's dive a bit more into those new revenue streams, especially content licensing. You mentioned the early deals. What's the real potential here for investors?
Management seems quite bullish on it. Pivotal, they called it.
Because they've only licensed a tiny fraction so far.
Exactly. Less than 5% of their content, non-exclusive deals. It suggests a lot of runway. They could potentially do many more deals.
But the sustainability is the question.
Right. Will AI companies keep valuing Chegg's curated content? What will future terms look like? And there's that strategic paradox we mentioned, feeding the competition.
A high-stakes bet. What about Busuu and Chegg Skills? How are they shaping up?
Busuu had that decent Q1, 7% growth, strong B2B. They're projecting maybe $48 million revenue for this year, aiming for that profitability milestone in early 2026.
And its AI features are helping.
Seems so. Things like speaking practice apparently boosted conversion rates quite a bit. Their freemium model seems to be working.
And Chegg Skills. That segment struggled a bit before.
It did. The whole bootcamp market shifted. But management is talking about a breakout year in 2025, aiming for profitability and growth in 2026. Focus is on workforce skills, AI training.
So the strategy is clear. Offset the core decline with licensing, B2I, Busuu, and skills. But the Q2 guidance still shows subscription revenue falling sequentially.
And that's the crux of it for investors. Can these new areas grow fast enough? The pace of that transition is everything.
Looking back at 2024 helps frame this. Subscription revenue down 14%. But that huge net loss, $837 million. What drove that number?
Almost entirely a massive impairment charge, $677 million.
An impairment, what does that mean practically?
It means they reassessed the value of their assets, goodwill, brand, technology, and decided they weren't worth as much anymore, largely due to, well, AI disruption.
Acknowledging the new reality in their books.
Exactly, a huge write-down, plus some restructuring charges. But it's interesting to contrast that GAAP loss with the non-GAAP income of $85 million.
So stripping out the big impairment and other items, the underlying operation was still generating some cash.
Some profit, yes, on a non-GAAP basis. But the GAAP number reflects that massive hit to asset value. A stark picture.
Yet, despite all that, they generated positive free cash flow in Q1 2025. $16 million.
They did, which is, a positive sign. It gives them some flexibility, some cash to invest in those growth areas, even while paying for restructuring.
But is $16 million enough to really fuel the kind of growth they need in Busuu, Skills, B2Y?
That's the question. It provides some capacity, but the scale of investment needed might be larger.
Okay, let's pivot to the users. Subscribers, engagement. These numbers tell a story too, right?
Oh, absolutely. And it's not a great story for the core business right now.
How bad was Q1?
Total subscription services subscribers were 3.2 million. That's down 31% year over year.
Wow, nearly a third gone in a year.
And the core Chegg Study Pack subscribers down even more, 37% to 2.3 million. The decline seems to be accelerating there.
That's concerning for the main product, but I saw ARPU was up slightly, average revenue per user.
Yeah, ARPU for subs was up 2%. Chegg Study Pack ARPU up 6%.
So fewer users, but paying a bit more on average. Maybe the less committed users left. Or price hikes.
Could be. But usually you want to see both subscribers and ARPU growing. Falling subs isn't a healthy sign, even if ARPU ticks up.
Feels like they're struggling to attract and keep users, especially for Chegg Study. What's the main cause there?
A lot of it seems tied to web traffic. They reported a huge drop, 49% year over year in non-subscriber traffic in January.
49%. Why so sudden?
They point directly at Google's AI overviews. People get answers from Google Search. They don't click through to Chegg. Cuts off a major acquisition funnel.
Okay, so how are they fighting back against that traffic loss and the subscriber drain? What's the plan?
Several things. Product innovation is one. Those AI tools, Solution Scout and Create, trying to offer something unique.
Trying to differentiate from free AI.
Right. Then there's marketing and brand building, although they just said they're limiting some upper funnel marketing to save costs.
Which might hurt new user acquisition long term.
Potentially. And third, they're actually suing Google over antitrust concerns. A pretty aggressive move.
So these new AI tools, Solution Scout, Create, they're central to keeping users. But how do we know if they're working? Are there metrics?
That's the frustrating part for observers, including investors. They say things like, very positive early indications for Solution Scout.
Which lets students compare AI answers with Chegg content.
Yeah. But they haven't released specific KPIs, key performance indicators. We don't have numbers on engagement, retention impact, conversion lift from these tools.
So it's hard to gauge their effectiveness externally. Investors need more data there.
Definitely. They need to show these tools are actually moving the needle on those declining subscriber trends.
So winning back students from free AI is job number one. How are they pitching that value?
They're stressing true learning outcomes, the reliability of their expert-verified content versus potentially flawed AI answers.
Positioning as the quality, trusted source.
Exactly. Plus, highlighting their specific AI tools like Solution Scout for checking AI work, trying to be a more holistic support system. And, of course, diversifying revenue so they aren't solely reliant on winning every student back.
But ultimately, investors need to see those subscriber numbers stabilize.
Absolutely. That's the bottom line for the core business.
And what about retention? Keeping the subscribers they do have. There were some positive signs in 2024, but Q1.
Yeah, that's another worrying sign. After some improvements last year, Q1 2025 saw Chegg Study Pack retention decline almost 1% year over year globally. U.S. retention also down.
So the positive trend reversed for the core offering.
It seems so. Suggests the competitive pressure is really biting, maybe even more than before, despite their product upgrades. Busuu, reportedly, is doing better on retention, helped by its AI features.
But the core Chegg Study retention dip is a big red flag for investors.
A very critical trend to monitor, yes.
Okay, let's talk active users versus, say, freemium users. How's conversion looking, especially for Busuu? That's often a good indicator for investors.
Right. So Q1 had 2.3 million Chegg Study subs, 3.2 million total subs. Busuu historically had over 100 million registered users, maybe around 500,000 paid subscribers last year.
And the conversion from free to paid on Busuu.
That's a bright spot. They reported a 31% increase in the 30-day conversion rate in 2024 linked to those AI features.
31% increase. That's huge compared to typical EdTech conversion rates.
It is. Much higher than the average, maybe around 2.6%. So Busuu's freemium plus AI model seems quite effective at attracting paying customers. That's encouraging.
What about the cost to acquire these customers? CAC, always crucial for investors. Any insights there?
No detailed CAC figures recently, but them saying they're limiting upper funnel marketing.
Suggests they're focusing on cheaper acquisition channels, maybe B2I, organic interest in the new tools.
That would make sense. It's a change from their brand push last fall, and with Google traffic down, SEO is likely a much more expensive channel now. Investors should definitely watch for any future CAC disclosures.
And how are they handling student feedback on AI answer quality, both from competitors and maybe their own platform? Got to keep users convinced they're getting value.
They acknowledge the concerns. Their own survey found over half of Gen AI users worry about incorrect info.
So Solution Scout is partly a response to that, letting students compare.
Yes, and create aims for more personalized, relevant practice. They constantly emphasize their human expertise and verification. But, online feedback is mixed. Some still find value, especially for complex stuff. Others complain about generic answers or service issues.
Maintaining trust and quality is key then.
Crucial for keeping those paying subscribers.
Okay, let's broaden out to the competitive landscape and AI's impact. It's undeniable that free AI from OpenAI, Google, Anthropic is a massive threat. How does Chegg differentiate enough to justify charging $19-20 a month?
It really boils down to educational specificity and accuracy. They argue their expert-verified content is more reliable for learning.
Plus the specialized tools.
Right. Create for personalized practice. Solution Scout for comparing AI answers. Trying to build a wrapper of trust and tailored features around AI.
But the challenge is making students feel that difference is worth paying for.
Exactly. That's the multi-million-dollar question. Investors need to see evidence that students agree.
And specifically against Google's AI overviews and Gemini, which hit their traffic so hard, what's the long-term play beyond suing them?
It's that mix. Legal pressure, product differentiation to offer unique value, diversifying revenue away from search reliance, and direct engagement through apps and marketing, trying to build resilience.
They do have that huge content library, the Q&A pairs.
Yeah.
How are they leveraging that specific asset in the AI era?
It's central. They use it to train and fine-tune their own AI products, aiming for better accuracy than general models.
And they license it out now, too.
Right, turning into a new revenue stream. The strategy is combining that curated data with tailored AI tools to offer something distinct from generic AI. Successful monetization of that library is key for investors.
And AI is being baked into Busuu and Skills, too.
Definitely. Busuu's speaking practice is a prime example, driving engagement. Skills offers AI courses and uses AI simulations. AI is an enabler across the board.
So when people say AI killed Chegg's business model, how does the company push back against that narrative to reassure investors?
Their actions speak loudest. The restructuring, the pivot to AI-enhanced tools, the diversification, the lawsuit, they're trying to project transformation, focusing on learning outcomes.
But the market's still skeptical.
The numbers suggest skepticism remains, yes. Performance has to follow the narrative.
And how adaptable do they seem? AI moves so fast. Can they keep up?
They talk about an AI model-agnostic infrastructure, meaning they can plug in new models like Llama or Claude as they emerge. That's smart.
So they focus on the layer on top, using their data, expert verification, specialized tools.
That seems to be the strategy, add value on top of foundational models. But it's a constant race. Can their value add stay ahead as the base models get better and better? That's the persistent threat.
Okay, shifting to strategy and innovation specifics. We talked about the lack of KPIs for the new AI tools. What should investors be looking for there?
Ideally, metrics showing adoption rates, impact on user session length, task completion rates, maybe direct links to retention improvements or conversion rates, quantitative data, not just anecdotes.
Without that, it's hard to assess. What about their overall plan for growth and retention in 2025, especially with marketing being tightened?
It seems heavily reliant on product innovation, making the platform itself more compelling, more personalized, building on the fall 2024 marketing, but maybe more targeted now, plus the diversification push with B2I and licensing.
But execution is key, especially while cutting costs.
Exactly. It's a tough balancing act.
Let's revisit Busuu and Chegg Skills. What are the specific growth strategies and milestones for investors?
Busuu. Keep leveraging AI for B2C growth, push hard on the B2B enterprise side, hit that positive EBITDA target in Q1 26. Potential for $100 IMS less revenue by 2026 is floated. Milestones are profitability and continued B2B wins.
And skills.
Skills. Position for that breakout year. Focus on relevant workforce skills like AI, expand partnerships like the one in India or with Guild, and hit profitability growth targets in 2026. Milestones are revenue turnaround and path to profit.
Busuu's freemium success seems important. What does that signal?
It shows that combining a freemium model with compelling AI features can work really well in EdTech for conversion and growth. It's a positive proof point within Chegg's portfolio.
And the institutional partnerships, B2I, how significant could that become?
It's a key diversification play, moving towards potentially more stable, predictable enterprise contracts rather than just individual student subs. Reaching that target of 40 pilots this year is a critical near-term milestone.
Okay, one last bit on strategy before we wrap up. The cost structure. Huge cuts announced. What are the headline savings investors should track?
The Q1 plan targets $55 million non-GAAP savings this year, ramping up to $110 million annualized in 2026. Add that to the $120 million from prior cuts expected this year.
So very significant belt tightening.
Massive focus on cost efficiency to shore up the bottom line while they try to grow the new areas.
Okay, let's try and synthesize all of this. For you, the potential investor listening, what are the absolute key takeaways from this deep dive into Chegg?
Well, first, it's undeniable AI disruption is real and hitting their core business hard. That's clear.
Right. Takeaway number one.
Second, they are responding with very aggressive cost cuts, trying to right-size the ship financially.
Got it.
Third, the new growth area is licensing, B2I, Busuu. Skills, they show promise, but, and it's a big but, they need to scale significantly and quickly to make up for the core decline.
And fourth, keep a very close eye on those core Chegg Study subscriber numbers. They are still heading in the wrong direction.
Fifth, they're innovating with AI tools, trying to build differentiation. The effectiveness is still TBD, though.
And finally,
The competitive landscape, especially with free AI and Google, remains incredibly intense and uncertain. It's a tough environment.
so given all that, what are the most important milestones investors should track going forward to see if this turnaround plan is actually working?
Okay, number one, progress on B2I. Are they hitting that target of 40 institutional pilots by year-end?
Number two.
Content licensing deals. Are they signing more? Are they bigger?
3. Busuu and Chegg Skills performance. Are they hitting those profitability and growth targets for 2026?
4. Stabilization of Chegg Study subscribers. Can they stop the bleeding or even see a rebound? That would be huge.
5. We need data. Actual KPIs showing the impact of Solution Scout, Create, and other AI tools if they release that.
And finally, 6. Are the cost cuts actually flowing through to improve profitability and cash flow? Watch the bottom line.
That's a very clear list of things to watch.
Yeah.
Definitely a company in transition. So maybe a final thought for you, our listener, to ponder.
Yeah.
As AI gets better and better at providing educational support, what really is the long-term future for companies whose traditional value was primarily human-assisted learning help? Something to think about.
A fundamental question for the whole sector.
Indeed. Well, thank you for joining us on this deep dive into Chegg Inc.
Thanks for listening.
Please remember to subscribe, give us a like if you found this useful, and hit those notifications so you don't miss our next analysis of companies and market trends.